Hello, sir. Hello, everyone. So, welcome to today's episode of Decoding Market in Three Moves. So, again, here I am, your host, Shubhajit, and today also with me there is the market bull, Mr. Rohit Srivastava. Hello, sir. Welcome back to this event once
Pleasure
again.
being back.
So let's again decode the market within three moves, that is three questions, so that it's easy for everyone, be it trader, investors, and even the newbies. So as we can see that the market has literally fallen down. Like it
Yeah.
should have given a breakout and it should go like gone up, but it has fallen down. So what's your opinion, sir, on that?
I think we discussed it last time, so it was very relevant to the question you asked last time that what about false breakouts? And we were in the midst of a false breakout above 25,000, and that has failed. So the failure simply means that the trend is the opposite of what was looking like, which means it's not up, it's down, and that's what we are trying to figure out. How far down can it go? That's the answer that we are trying to look at. My sense is it'll break the recent low of 24. I think 440 or 460 is sort of the range it went to. I sense we are going to break that. Let's see. Tonight is an event. Again, that's the FOMC meeting that may play some role apart from whatever geopolitics is going on in deciding what happens next.
So like we have talked about false breakout and we have talked about like people are getting excited about all these things. So what is that one market signal that you believe most investors still ignore, but always that thing always come back to them and haunt them, but they ignore it in every situation.
So it's a tricky question because people do ignore market signals. That is true, but everybody has a different market signal for themselves. I might look at sentiment and RMI as my top two. Somebody else might have something else. Hopefully, they are not looking at a signal which is subjective. It's like, for example, I know some people who are looking at a signal कि मेरा ये client है वो तेजी करता है तो मंदी हमेशा होता है. This is a kind of signal typical of sales guys who are in touch with customers. I'm not saying they may not be wrong. Maybe their customers do have that knack. And in trading, a lot of people lose money. So it's the easiest thing to say, oh, if the trader is doing this, let's do the opposite. But that's not scientific in terms of process. But what happens in terms of ignorance, even for someone having a signal, is that, say, for example, I'm using momentum swing. Okay, now that's our own proprietary short-term swing indicator of an oversold market. Every time it falls below 10, we say the market may be getting close to a bottom and can bounce back. Bounce back or resume the upward trend depending on the situation. But here's the thing, you don't get a swing oversold reading every day. It happens once in 3 weeks, 2 weeks, 1 month. What do you do between today's buy signal and the next signal that will come after 3 weeks? And this is where the ignorance happens. So what happens is, वो तो आ गया, now it is gone, swing is gone from 8 to 20, 30. Now what do I do? If I booked my profit, now what do I do? So logic says wait for the next signal. But for a trader to sit ideally and do nothing for 15 days is the most difficult job. So what many times will happen in practice is that he will go and do something. And that do something will end up becoming a disaster. And when that actual signal to buy again shows up, either he'll not be looking there or he will not have the money to take that trade. So this
So
is this is
here comes the trader psychology of like every trader has their own psychology and their own set of rules. I like you might be following some set of rules that you have like you are designed and it's for you. It works for you.
yeah.
It might not work for someone else or some other traders. So what do you think? Like what is the emotional angle? The traders like they actually ignore the pattern sometimes and they follow their emotions. So what's your take on that? Like, is the emotion, sometimes the emotions also bring them profit, but it's not true every time. Once in a
Yeah,
while, it's a probability.
so it comes from something else, right? One reason I gave you is simple impatience, that you want to do something all the time. You can't sit quietly. You can't be idle, and that's the reason you're ignoring your signals. You're trying to do something on instinct, which doesn't work. So one solution to that is that don't deploy too much money on instinct. I'm not saying don't, but I'm saying don't deploy too much. So that means you can set a percentage. Let's say if I'm going to deploy 10,000 rupees on this trade, then probably on instinct I will not do more than 1,000. Now that can be a limitation, that you can actually limit your loss if something goes wrong, because you're only doing it on instinct and not based on signals. And when the signals show up, then you can increase your deployment from 1,000 to 5,000 or 10,000, whatever it is. So that's one way that you can actually control, is know that you're acting on instinct. First of all, you have to know. So it's a realization that you have to have, because sometimes you don't feel you're acting on instinct. You feel you're acting on science, but it is not defined. It is your instinct. अरे हर बार ये कैंडल ऐसा दिखता है तो ऊपर ही आता है, but how is that scientific? Have you back tested it? Is it logical? So therefore, like for example, candlesticks. Every time will you buy on an engulfing bull candle and will you make money? Have you back tested it? And if you back test it on meta stock, which allows you to do that, you might see results are very, very bad. So you just can't act on a pattern without a plan. So there's got to be more to the plan. And when you have a plan, then it's about whether you're executing your plan. Awareness that yes, I'm in the plan or not. And if I'm not acting as per plan, then am I betting too much on it? So don't bet too much on instinct.
So, just another question regarding this. So, can you walk us through a moment when the markets actually like spoke or given some signals, but you were the one of the few that actually captured that, and literally it made a huge thing.
So I can go back to when the Nifty had hit 15,200 of June of 2022. And it is pretty much on record, because I and Chavan were recording Weekend with Indiacharts. All the episodes are there. And we were sort of debating whether this is a counter trend move or a trend move. And I'm looking at sentiment indicators and the wave structure and saying that irrespective, we are going to go from 15,200 to 18, not 18, but maybe at least 17,000 something. Okay, just on the structure. And at 15,200, even after it had recovered to maybe closer to 16,000, FIs were still short on the market significantly on a historical basis. So looking at all those data points come together, the what we call as sentiment indicators on strike. Maybe I can just highlight it for a moment. So once again, I will show people. So he used to argue with me that no, what if it's a bear market rally and it's going to come down? I said, irrespective if it's going to be big, then what I need to do is go bullish now and then figure it out later. What if it doesn't come down again? So the argument was like this, and this is so argument was that if this is a bear market rally, it's going to come down. So why are you getting so bullish? I'm talking about this phase from here to here. Okay, and this entire phase here, you see the positioning of FIs was on the short side. It was going up again, getting shorted, going up again, getting shorted. That was all the way from here to here. And if I actually put this on a bar chart, let me see if we can do that here. Okay, then you even have a trend channel. So now I'm zooming in just to show people. Okay, and I remember it because, like you said, show an example of something you did. So when you do something, you can't forget, right? So you see this trend channel, it held perfectly. The pain point only was that it took a little bit of time to get the big move here. So this is the big move. What you really need is patience in the early stage. Patience in the early stage means from here to here and then here to here to hold on. So what happens every time, and what is happening in this range is every time it is dipping. So it was going up, retracing 50-60%, going up, retracing again 78%, going up again, retracing 60% of those gains. So it was really not giving you significant gains, but retracing and giving it back again and again. And I'm trying to hold on to an entire trend. So what is happening is you make some money and then you watch it all go away. Then you say, no, it is still at the bottom end, you should add again. So again, you add on, and then again it makes some, gives it away. And sort of here I doubled up or tripled up on the trade, and the payback only came much later. So this is like almost 1 month of waiting for it to actually play out. And for those who understand wave theory, they can even see a very clear 1, 2, 3, 4, 5 coming out of this eventually. So yeah, that is my example of what happened. Yeah, I'm sure there are some other indicators. I've only taken FIs. There definitely a couple of other indicators that were oversold at that point of time. It could be the, for example, we can actually put call ratio, open interest. Let's see. Yeah, so this was oversold here, but it was already rising till this point. It had already risen quite a bit. Okay, so it was oversold at this bottom. If I take the breadth indicators, this also was very oversold here. Okay, so the one that remained at the bottom end is possibly the FI. See, all of the rest, showed the bottom here, and had already started to advance with the market. The market was not taking off, and this was still extremely short. So this is sort of an example. It tests your patience, tests your conviction, but eventually pays off. Sorry.
So that means being disciplined in the market is the key.
What are you saying?
So it's like being disciplined in the market is the first key step towards making a good footfall.
Yeah, there's the discipline. There's this watching your tools and believing that your tools will work. There's also some amount of position sizing. Like I mentioned that, out of 10,000, you do 1,000, etc. So even as it is bottoming down there, initially you have a lower conviction. You don't buy all at once because it takes time. So all the times it went up and came back, went up and came back. You buy a little bit, and then you add a little more and you add a little more. And when your conviction is most that yes, the channel is holding, you still have an oversold condition, is when you really add up to it. And that's a process.
So leading us to the next question of the series, as there are too many newses, okay, there is noise, like there are opinions, anything coming, tips. There are certain narratives of different persons. Like
Yeah.
in this entire noise, how you declutter and filter through these and put your opinion. Like, ye jo hai, this is my thing, and this is gonna work. How do you filter the things?
Yeah, so I'm actually going to direct people to a very interesting video I recently did with Joe Stocks on the subject of news and events. I'll explain it also. People can listen to the detailed thing. But here's the main point. The main takeaway is that from a market analyst point of view, news and events always follow price. Okay, news and events always follow price, which means that by the time you hear about a news, whether it's Israel war or whether it's the FOMC meeting, it's already in the price, and you have to really believe that. So more often than not, you see that the market's reaction to news and events is not more than a day, because
Right.
by that time it's already priced in. And we can see the most recent reaction. Oil prices were already rising ahead of what happened in Israel. Okay, so it was already getting priced in. Somebody knew that these attacks were building up. The rumors were there one day before. Even I didn't hear the rumors, but now I'm hearing that they were there. And prices had moved up. So on the day that the attack started, you only saw a 1 day spike to $78, and then it sold off. But people who are listening to the news and say, oh, now the news has come, now oil is going to go up, and you're going to go and buy at $78, thinking that now it's going to go to 100. It is not going to happen that way.
You're already stuck in the trap.
Yeah, and that's exactly what happened on the Trump tariff. Since January, in fact, since the elections, he was saying, "I'm going to put tariffs." Tariffs is the most beautiful word in the dictionary, and so on and so forth. Then he won the election. That was in November. Then in January, he was saying, "I'm going to put tariffs on Europe." Okay, and then he put a deadline that I'm going to have tariffs out by the last week of March or first week of April. So everybody knew the 4th April deadline. So this is like 4 months of transmission of information. The market is already prepared by falling ahead of the event. When he announces it, it reacts for one day, and that becomes the bottom, and then it turns around from there. And that bottom is not seen again. So this is the behavior of news, and so I just, like I said, I've done a video. I'm in fact just trying to share. Okay, so this video people should actually go out and check it out. It's on Joe Stocks. The topic is really event-based trading. Okay, very detailed insight into various aspects of how events and markets play out. The use of sentiment indicators to know in advance which way the markets are going ahead of events. And events just follow. I mean, price action happens, events happen. Now, there's a psychological reason for this also, and that's explained in Elliott wave analysis. So, in Elliott wave analysis, we do 1, 2, 3, 4, 5, right? And we do ABC. Now, typically, if there's a huge negative event, it often happens in wave C of a corrective pattern. So, A happens, B happens, and then when C is going on, all of a sudden, all the bad news is there. And it sort of bottoms out on that bad news. It doesn't fall anymore. So when news comes, that's when you need to be preparing for your exit. But hopefully you were reading the market signals and believing the market signals when they were telling you it's going to go that way. So what happens, and so takes you back to your first question, what signals do we end up ignoring? I think if you ignore indicators, especially a lot of people don't use the sentiment indicators we have on strike, but if you're ignoring these indicators, then and they're already telling you in advance that something is going to turn. Let me give you an example which is today and now. Okay, people want to know what the market is going to do today, or why did it fall last week, like if they haven't figured it out yet. I'm going to show you the 40-day AD ratio. Okay, let's remove all this noise on the chart and see what was it doing just a couple of days ago. You see, we have put red lines here which show the overbought, oversold, like extremes of the market. Okay, this had reached right here, over here. This is the top end of the range. Now, when you are at this kind of level, what are you doing at this point of time? Are you reading this signal as overbought, or are you ignoring it, saying, "Yeah, theek hai. Breadth was high here also. What does it matter?" But it did matter in terms of a 2-3 day dip. It happened here. And what happened after that is here you got the announcement of the Iran-Israel war, right? And it could have been anything. I mean, it doesn't have to be an Iran-Israel war. It could have been something else. My main point is that news just follows price. Price is always ahead. Say, for example, this is price. This is the Trump tariff. Price is already selling off. Even if I use the RMI indicator, it was already in sell on this day. So our own RMI indicator is already in sell ahead of the event. Question is, which side of the indicator are you? So we do ignore, you're right, that people ignore, because what happens if you have taken a position and then it starts going against you? You can't believe that it's against you. You keep waiting. नहीं यार इतना प्रॉफिट आ रहा है, जाएगा थोड़ी, अभी इतना ऊपर आया है तो नीचे थोड़ी आएगा, इतना ऊपर आया तो नीचे थोड़ी आएगा, and then it starts coming down. So you don't sell. But you have to have some level of some kind of a trailing exit in every position, because if it's reversing, when are you going to accept that it has reversed?
This is where the FOMO works for people.
Yeah, it does, because
they think
you
that
want,
they think that और आना चाहिए, profit और आना चाहिए, और अगर अभी निकल गया तो we will be on loss.
yes,
And this ended up like eating them most of the capital.
yeah.
Very true, sir.
So you always have to take some money off the table. I mean, that's something some people used to find that a very, very interesting line I used to make in the mentorship program. Taking money off the table is like one of the most important things. The only money you make is the one you've taken off the table. And now, for example, are we oversold here? I mean, like, is the market ready to go up or down? That's the next question. And we have couple of readings from time to time. I mean, say like let me give you a couple of readings. Like even back here, you had the India-Pakistan war going on. The swing is down here, oversold. And on Monday, you hear that we are having talks and gapped up. Question is, would you have read this low swing reading of 6 as a good reason to really get out of your short positions? In fact, on the day it is down, the swing was actually going up, so there was a positive divergence. It was 15. It's just a question of whether you read it or not. It happened here, right? You had a one-day announcement of war. The reading was down here at almost 12, and then it bounced. And I'm not saying it went to a new high, but it did bounce. It gave you a 60% retracement from an oversold reading. Now it is falling. It may fall again. It may fall again till you get another oversold reading. It may even go into single digits. But by that time, where will the market be? Will it be here or will it be down here? And then when it's there and your swing is down here, are you going to be buying or not? Or because out here, you'll get news. You know what news you'll get? US has entered the Iran war. That's it. Nobody can buy anymore. But the reading on the indicator will be extremely oversold. Time to buy. What are you going to do? So it takes some mental training to first accept that news follows price, and then when news comes, it's time to change direction. Unless it is game changing news. See, we don't always get game changing news. All news is not game changing. All events are not game changing. So that's what I've explained in the video. There are micro events and macro events. Macros are which are going to change something permanently for months to come, years to come. There are very few such events. Even COVID had an impact of only 1 month. Why? Because the news transmits so fast today's electronic age that the reaction time is very fast. In the old days, it would have taken months to happen. Market would have been down slowly and steadily for 1 month, 2 month, 3 month. हाँ कोविड हो रहा है, कोई नहीं खरीदना चाहता है. ये तो क्रैश होके बॉटम होके भाग गया. Nobody could believe it. So a lot of people remained bearish through the entire COVID rally, except all the smart investors of India who were sitting at home, had nothing to do, and went and bought stocks. It's a reality. It actually happened. All the people who were doing work from home just thought they should buy stocks, and retail investors got in and made money. And then people were saying retail is buying, so market will come down. It never came down. So a lot of misjudgment. But point is, events play out very fast now in today's day and age. Micro events, within a day, they get discounted. So by the time you hear the news or event, it's over.
So similar is the case with the tax and all. The before when the tax news used to come, the market used to retrace like for a long. It was a macro
Yeah.
event back then, but now it has become micro event. Maximum
Yes.
a day or two. Hardly it
Yes.
stays.
Yes, that is
And
correct.
moreover, this tax regime also doesn't affect the market in that way nowadays, as it
Yeah.
used to hit the market when in like I was a kid and like it used to literally my parents used to sit in front of the TV and watch what is the new tax regime has come, what are the new things in the come. Now it's like okay, tax is there, okay, that's
Yeah.
that's the
Yeah.
new thing. What
Very
had
true.
happened,
What you always said is very, very true. It used to be a big thing, reforms. People used to
right?
go to listen to the union budget. In Mumbai, there used to be entire, uh, you know, Maidan that used to be full of people listening to this lawyer. I'm forgetting his name. It's a famous guy, and people used to go and listen to him on every budget day. Gone are those days. Now it's like just a few changes here and there, and theek hai.
Right.
This means this will go up. This means this will go down, and one day later, it's all over.
True, sir. So let's conclude our session today. It was a very good session. It was very
Yeah,
good. And now let's take three questions from our viewers. So
definitely.
viewers, now it's your time. Just throw any three questions and we will select from them. So good old days, what people say, like there was tremendous amount of space that people can use and make money. Now that space is getting shorter and shorter day by day.
Yeah. So there's this question by Tanishk, who says, I'm new in markets. I have a question which might sound naive. From what I understand, technical analysis tools work as they encapsulate a pattern in human psychology. Is it also possible that it works because we choose to believe in it? Is it a self-fulfilling prophecy of some sort? No. I think the first part of the answer, Tanishk, is correct. And you will believe in that more when you get into a little more advanced science like Elliott wave analysis, which is essentially the pattern of human behavior reflected in markets. And it's found that pattern to be repetitive. Some people do try to tell me that it's just luck you caught something, but luck cannot be a repetitive pattern, right? I cannot get lucky 4 times. I'm using the same methodology for since at least 2000. The that I formulated, I mean, from 1990 to 2000. That's 10 years I spent learning technicals, Elliott wave analysis, creating the RMI indicator, putting together my thoughts of how I should trade in the markets or invest in the markets. And since then to date, I'm using the same methodology and models. If they were self-fulfilling, then I would have been wrong uh, more often than not. And that doesn't mean I'm right 100% of the time. It's just that whether you're doing 60-40, 70-30, are you able to achieve those kind of goals, being right more often than less, 30% time wrong, then you have a methodology that works with a probability. But if it wasn't, then it would be self-fulfilling. So that is not true. It's not self-fulfilling. It is actually a reflection of psychology, and that's partly why I used sentiment indicators also to explain my thoughts, because in the end, sentiment is what? It's again psychology. Sentiment means is everybody selling, so then all stocks are falling, which shows up in all stocks momentum going down, which is what we try to then measure with a swing indicator. If everything is crashing, then probably it's the bottom. That's what the indicator does. So it's really trying to read the psychology, and which is why we call them sentiment indicators. Or if you're looking at the positioning of FIs, right, we are talking about, okay, are all of them bearish as a group? And if they are as bearish as they have been historically, then possibly it's time for the market to turn. So psychology plays a big role. So you should probably study deeper into it, Tanishk. There's a lot into it.
So moving on to next question by Jigar.
Sentiments are bearish but not falling. Seems to be time consolidation. Yeah, that's a possibility. But we are falling slowly, I would say. See, the ability to not cross 61% retracement. 24,950, I think that was the 61. 66 is 24,980. We didn't cross that range, and we have fallen for 2 consecutive days from there. So I wouldn't say it's not falling, but yeah, it may feel like, oh, today it didn't fall by many points and therefore it's not much of a fall. But maybe we are below, I don't know if we are below the 20 DMA today on Nifty. Are we? 24812, yeah, we are. So it's a slow, it may have slowed down, but there's also an event tonight, so which is why the market is not reacting. It's probably waiting for global markets to react to the FOMC. So give it time. If it doesn't move for 3-4 days, yes, I will accept that it's a time consolidation. Now, again, time consolidation is a question of, are you looking at very micro time or macro? So, for example, 1,000-point range can also be a time consolidation if you're a long-term investor. And right now we are looking at only a pullback in a bull market. So, therefore, it is a correction or consolidation only if your view is slightly longer term. In the short term, a correction is a downtrend. In the medium term, it's a consolidation.
So coming to the last question of today.
Vaibhav, I have a
Yeah.
question to Rohit for delivery stocks. Are 200 DMA and 100 DMA entries are good, meaning I enter a stock only when it breaches 100, 200 DMA plus strike seasonality also a favor. Yeah, it's a workable thing. Only thing that because 200 DMA whipsaws a bit, I try to use the weekly averages, which are almost close to that. The 40 or 50 week is close to the 200 DMA. The only thing is on a weekly basis, it may not break that easily. Otherwise, sometimes stocks will fall below it for a few days and come back above it, and then you wonder whether it broke or not. So that's the only thing, that if you're doing long term, why not use a higher time frame average rather than a higher value average?
Right. So that's it, guys. Thank you, sir, for today's show. It was a good show. And thank you, everyone, for joining. Let's meet on the next episode of Decoding Market. Till then, stay tuned and trade smart. I will suggest trade with strike. That's better.
Yeah. Thank you, everyone. Thanks, Shubhajit.
Thank you. Thank you, sir.